Well, welcome, ladies and gentlemen, to Grant's Interest Rate Observer Radio. I am here this morning. It's still morning, I think. Yes, it's still morning. I'm here with Eric Whitehead at the controls. He is our sound engineer, and the great Evan Lorenz, analyst par excellence, is sitting directly across from my cluttered desk. Good morning, Evan. Good morning, Eric. And good morning, ladies and gentlemen. I am Jim Grant. We are here today to, I think we'll talk about risk, Evan, in its many interesting forms. And we are going to see what we can do to clarify things and maybe think of an investment idea or two. I don't know. It depends what turns up. But first, a word from our sponsor, who happens to be me. Now, there is no bad time to subscribe to Grant's Interest Rate Observer. That is for sure. But now just might be the best time. Now, when markets are making highs and volatility is plumbing lows, and the SEC staff, in its wisdom, has waved through the first quadruple leveraged ETF. We at Grants are the yes, but people. We are skeptics, doubters, first guessers. Whether it's a macroeconomic theory, some crack-brained central bank doctrine, a common stock, or a subordinated debenture, Grants puts it to the analytical test. We publish every 2 weeks, 24 times a year. Hey, visit our website and read for yourself, see for yourself, and, as we encourage every reader, think for yourself. Subscribe to Grants. There's no time like the present. So, Evan, you handed me, before we sat down, a wonderful piece of commentary in the Times. It has to do with the algorithmicization, if that's a word, of the insurance business. Do tell what you have found.
Sure. In yesterday's big read in the Financial Times, there's an article about insurance companies using algorithms to replace underwriters. And what really drew my eye is life insurers are now allowing consumers to submit selfies, pictures from their phones, and they'll underwrite life insurance based off of that. They'll look at the picture and see, are you aging well? What is your BMI? Do you smoke? How do you look? Do you have, I assume, a tan? I mean, do you look healthy? Do you look happy? Then they'll use all that information from the picture and that picture alone to actually underwrite a life insurance policy.
Reminds me a little of mortgage underwriting in 2003, 4, and 5. No need to show up personally. Your agent would do, and no need also for scrupulous truth-telling on the application form.
Not only that, but the economic models of that time actually ruled out the possibility of a nationwide real estate bubble. They said real estate's always a local market. It's never happened before. It will never happen. And if you listen to Chair Ben Bernanke up through 2006 and 2007, real estate was constrained. While it was frothy in some markets, there was no problem nationwide.
Well, I think perhaps the underlying point is that risk is always with us. It takes different forms. In fact, I have also furnished by my confrere Evan, I have a wonderful piece of writing from one of the more thoughtful people in central banking, Andrew Haldane, who's connected with the Bank of England. And in 2014, I believe, he gave a speech. And the speech contained these 2 paragraphs. I'm going to read them because I read them when they came out. I was so struck, and I'm happy to be reacquainted with them now, and perhaps you too will enjoy them. So here it is. Well, one of the likely consequences of the great financial crisis, so says Andrew Haldane, and the resulting regulatory response is that the financial system will reinvent itself. Financial activity will migrate outside the banking system, and with that move, risk may itself change shape and form. What previously had been credit and maturity mismatch risk on the balance sheet of the banking system may metastasize into market and illiquidity risk on the balance sheets of non-banks. This could have important implications for the stability of the financial system and the broader economy. And it gets even better than that. So Andrew Haldane continues, with more activity outside the banking system and with the banking system itself better protected, the financial system and economy may become less prone to low-frequency, high-cost banking crises seen in the past. But that is not the end of the story. Risk, like energy, tends to be conserved, not dissipated, to change the composition, but not its quantum. So it is possible the financial system may exhibit a new strain of systemic risk, a greater number of higher frequency, higher amplitude cyclical fluctuations in asset prices and financial activity, now originating on the balance sheets of mutual funds, insurance companies, and pension funds, rather than banks. These cyclical fluctuations could in turn be transmitted to and mirrored in greater cyclical instabilities in the wider economy. close quote. That was Andrew Haldane holding forth on the ever-shifting nature of risk. That was a few years ago, but certainly it rings true today. Evan, we have been writing in the past several issues of Grants about risks not quite clear and present, but rather nuanced and subtle. And we have been talking about, among other things, a new kind of portfolio insurance. Way back in 1987, the conceit was propagated by Wall Street that rather than buying puts or raising cash to protect your equity portfolio, what you could do was to wait until the moment the market took a turn down and then to sell in a most scientific way certain portions of the portfolio, and that would protect you. Timely and targeted selling. That might have worked for some, but it did infamously did not work for all. And the market one fine day in October 1987 was down more than 20 percentage points. Do you see, Evan Lorenz, do you see signs that people are leaning too heavily on gimmicks, on new techniques that they think are going to neutralize risk that will keep us all safe, when in fact we have all been behaving as if we are going to wind up in a ditch someplace?
Absolutely. Bloomberg had a headline today that the Harvard University's endowment single biggest public investment right now is a high-yield ETF. If that's not a sign of something, then I don't know what is. But it seems like the belief that better models and better technology can insulate your portfolio and give you better returns is an evergreen one. Today, one of the ones that we've written about is risk parity, which is the idea that you can leverage up a portfolio of super safe bonds because they're safe because governments issued them, buy some equities and buy some commodities, and somehow you'll get a better, lower volatility return stream than if you just own a 60-40 portfolio of stocks and bonds.
From time to time in the long history of human affairs, people do invent things that improve our lives. In fact, the improvement in the human condition is one of the great threads of modern history. It certainly is undeniable with a look around the world. It's a world of wonders. So it's not as if we humans have not improved our lives. We have in countless ways. What is it about finance that seems to thwart the well-intended inventions? They seem to I don't know. There's something about financial activity. I think in the pages of Grants you can read the quotation perhaps more than once that whereas progress in science is cumulative, we stand on the shoulders of giants. Progress in finance is cyclical. We keep on stepping on the same rakes.
Technology improves, information spreads faster, but we just can't get rid of people from the whole financial system.
That is the trouble, isn't it? One of our readers, Michael Harkins, who I think is among the longest tenured subscribers, was around in the 1970s when a friend of his, a very accomplished investor, was bewailing to Michael. This, again, was about, 40 years ago. That it was much harder, he said, this investor said to Michael, it was much harder to make money because the markets had become more efficient, because the days had long gone when the only research available was an S&P tear sheet, one of these things that you found in a loose leaf binder that gave the vital signs of a company, and that was about it. The trouble was, said this investor, that markets had become efficient because information had become ubiquitous. That was 40 years ago. And certainly, if ubiquitousness takes a modifier or an amplifier, it has become more universal. Again, if that's possible, we are immersed in data, whether we want it or not, want them or not. I'll correct myself. And yet, as Michael Harkins observed, we seem to have come full circle in that with all of these data, with all of the information available to us from conference calls and SEC filings and proprietary sourcing of customer flows, you name it. With all of this available, the world has elided into the conviction that research is futile. Right? That's the one of the memes of the present day on Wall Street. That research is, if not futile, it is of of a low-yielding activity. Why? Because we all have it, if you follow. So passive investing is popular as never before. ETFs are popular as never before. ETFs, of course, consist of a number of securities, but you can't pretend to be picking those stocks or bonds conscientiously if you were buying them 15 and 20 at a time. So as the ability to make distinctions and judgments about operating businesses with securities attached to them, as the ability to make these judgments has increased, we have seemingly turned our backs on the act of choice and of selection.
And kind of on that line, news came out this week that there are actually more indexes of stocks than there are stocks in the universe.
Well, I guess that's a very good thing for the index mongers. In the current issue of Grants, and I must be careful to not to tip away the what we are pleased to call the proprietary research, but there's something I do want to talk about. Took note of a fabulous book. I'm rather late to it. The title is No More Champagne. The author is David Lau, and it came out 2015, I believe. The publisher is Picador. My good friend Paul Isaac sent me a copy, and belatedly I took it up. No More Champagne is the story, the wonderful, engrossing, nightmarish story of Winston Churchill's reverse Midas touch. Now, Winston Churchill was obviously one of the great statesmen of the 20th century, perhaps the greatest. He must have been the worst investor ever born. He was given to every single error that characterizes poor investing and poor investors. He was impetuous in his decision-making. He reveled in leverage and in rumor, and he would conceive from time to time a very prescient thought, but he wouldn't stick with that thought. He would take a profit or sell to cut short a loss, and he would pay his brokers more than he paid his estate finally. But he was, my goodness, what a demonstration of human frailty, and what, by the way, a demonstration of how fallible is even the greatest human specimen. Churchill certainly being one of those great specimens. What makes Churchill's financial life so fascinatingly awful for me, a middle-class kid from the middle of Long Island, is his insistence on skating at the edge of insolvency. God, you read this, you almost break into a cold sweat. I mean, he made a lot of money. He was, of course, one of the great stylists of his time. He wrote book upon book. He was sought-after speaker. He was fabulous at that as well, a good parliamentarian. And he made income that put him certainly in the upper 1 percentile of British earners, yet he spent just a little bit more than he earned, always. It's as if he was on a mission to almost become insolvent at all times. And I don't know how David Lau does it in this book, but he carries forward this narrative of financial risk-taking and near ruination through more than 300 pages. You often get appalled, but you're never tired. He ties in the politics with the personal financial narrative. It's a fabulous, engrossing, and horrifying read. And he kind of treats the biography of the British pound in a parallel fashion. You can see the debasement of the pound as Winston Churchill proceeds to debase his income and his net worth. It's some kind of Gothic read, Evan. I'll say that. I hardly recommend this book. It's wonderful. So what else? Here it is, the Wednesday after the Tuesday, which we go to press, and I think we are both to be commended for being upright. But I know something else is on your mind, Evan.
Yeah, well, Churchill showed just how to buy and sell wrong, but it seems like that's not necessarily something unique to him. Right now, one of the most popular investment strategies is selling volatility in one form or another, whether that's buying an ETF that does it for you or selling puts. The VIX has been plumbing 24-year lows over the last few weeks, and as it's plumbing lows, the strategy of selling volatility is becoming even more popular, and it just seems like people are kind of piling into what's working without giving much thought to the shape of the world. And as you mentioned at the beginning of the podcast, that risk can't be destroyed. It can just be moved around.
Yeah. And in the meantime, I can't help but noticing, looking at the newspaper, that not all is well in Washington. And, and the pages of Grants have described, I think the 45th president is the incumbent, is it not? The 45th president, yes, Donald Trump, is an unconstrained bond fund without the compliance department. I don't know, it seems an awfully peculiar time for people to be collectively reaching the conclusion that there is not much risk out there in the wide world. And indeed, to be selling volatility, which is it's a concept that takes some getting used to, doesn't it? Volatility being a kind of an ethereal thing. It's movement. It is not a stock, not a bond, not a bar of gold. It's not a thing exactly, except, oh yes, it is a thing. Billions and billions of dollars are being, shall we say, invested, gambled, speculated in the movement of securities prices, as opposed to those prices themselves, as opposed to the businesses that stand behind those prices. You do sometimes wonder, at least I wonder, where actually is the underlying. We know what the derivatives are. They make the headlines, but the businesses themselves somehow seem to have been pushed out into the shade. We have 2 weeks, Evan, to produce another copy of Grant's Interest Rate Observer. Can we do it?
I hope so.
Well, I can be more emphatic than that. Yes, affirmatively, we will. And in the meantime, we will talk to you from the studio in our area on the 6th floor of 2 Wall Street. So for Grant's Interest Rate Observer Radio, I'm Jim Grant, and I thank you for being with us today.